Good evening, everyone. Time for another silver update. I apologize for being out recently. Had some dental problems. Those are taken care of. So let's get back to silver. Now, this is the big chart we've been looking at. This is the one I've been talking about, the crossing over of the MACD. And you can see here that the red line is starting to rise and the blue line is starting to level off. If we go and zoom in here a little bit, we'll try to get in where we can see a little bit closer. So you can see that the blue line is almost turned up. If we go back to the last historical example, you can see that when the blue line finally turned up, it comes right about here. That was after a little bit of a rally from 8 to about 14. And a lot of people, I'm sure at that time, thought that, well, that's quite a move, so it's probably going to pull back from here. Actually, it was quite the opposite. That was just the beginning of, you can see, this massive bull move in the price of silver. So this is doing what I predicted that it would do, and hopefully if it closes the month, as I said, around 22, that will probably give us a crossover of this MACD. We'll just have to wait and see if that's how the month ends. Now I want to go in a little bit closer here to show you some of the action that's been going on. So let's go to the 5-minute, and well, it looks like we're now getting a nice breakout here right in the after hours. We want to clear off the indicator and just put up the volume here, because volume is going to be what we're going to be talking about most of the rest of the night. And let's pull out to the 15-minute. So you can see on the 15-minute, first of all, silver starting to behave in more of a bull manner, and the way that bull markets work is, and I've pointed this out many times before, this is the idea of the reverse battering ram principle, the way that they move into new highs. Jesse Livermore was the first one to point this out. It's the way that support and resistance work. So a market will batter its way up to the old high, and a battering ram, normally you have to go back farther and farther before you break through something. I call this a reverse battering ram because what happens is markets get closer and closer and closer until finally they just bust through to the upside. And that's how you get these pennant or flag formations. That's why a pennant has a rising slope. And so that is apparently what we're seeing here. Looks like the chart isn't updating. So, but I wanted to go over to, we'll come back to this chart. I wanted to go over to a comment that was on the YouTube video. It was an interview I did with Elijah on finance and liberty. And this was a question by Tommy B. And he asks, and this was a question that I was asked in the video, in the interview. Brother John F., you didn't answer my question. Whether the cost of production of silver is $20 to $30, or if it is unknown as you believe, and which may be true, on what fundamental basis do you think silver should be in the triple digits in dollars per ounce? You answered the question by disputing the cost of production numbers that miners report, but that doesn't answer the question as to why you think silver should be $100 an ounce or $500 an ounce or something else. There has to be some reason in which you're picking those numbers, and I would love to hear your thoughts on that. Now, I tried to answer this down below, and apparently my answer wasn't clear enough. What I said was, good question. The number disputed is about supply. My projections are also based on demand. How much money does it take to buy 1 billion ounces? $20 billion? What about $200 billion? That is 3 months of the deficit. Who has 10 billion ounces of silver to deliver, ever? Think about it. So let's keep that 1 billion figure in mind here and go back to the, actually we want to go back to the 15-minute chart. And the reason why I chose that is because you have this one particular volume spike here. And that comes to 200,000. Now, I'm going to assume these are contracts. There's been a lot of dispute about that, and we're going to look at the CME contract specification here in just a little bit. But I believe that NetDania pulls from many sources, and this is just world volume. So this 200,000 contracts, if that's what it is, that represents that billion ounces of silver, or $20 billion. And that's fully valued. So if you're talking about a margin requirement, then normally margin requirements are around 5 or 6%. So if it takes if it's $20 billion of silver, then it only takes 5 to 6% of that amount of money to control that. So what's that? $1 billion? So someone apparently had to plunk down about $1 billion right here. And you can see this is a bit different than the past action that we've seen in the chart, because normally when you see a huge volume spike like that, we'll put the lines in. When you see a huge volume spike like that, normally that coincides right with the top, and it actually coincides with the capping of price action. And you can see that it coincides here. It didn't come in here, although there was a large rise in volume at this breakout. And again, this is a key breakout that I had been looking for, that had been going on for a 3-year downtrend. It was this breakout through it that was the key one. And you'll notice that now this rising pennant, we have not tested the place where this volume came in. We just briefly tested it. So if you imagine that this was somebody taking that investment, $1 billion, and planning on actually ponying up the $20 billion and standing for delivery of 1 billion ounces of silver. The question is, who can deliver 1 billion ounces of silver? Anybody? Because you know that we only mine about 750 million ounces of silver per year in the entire world, and that more than half of that goes for manufacturing. The United States only mines about 50 million ounces. So that amount right there is 20 times the amount of silver that's mined every year in the United States. If someone chose to stand for delivery, that's going to be game over. Now, that gets back to the question. Again, what I was talking about was demand. How much demand does it take? In other words, how many dollars are out there that can demand delivery of silver? Well, there's a whole lot more than $20 billion worth of dollars out there. So that's why I gave the price of 100, 500, and various much higher prices for silver, is because if that money ever does chase silver, then and actually stand for delivery, then the price is actually going to be an unknown number. There's no way to know what that price is going to be. Now, he followed up with another question, or another statement, saying, I just don't see the fundamental justification for triple-digit silver, as the supply of silver is relatively stable and the demand curve for silver is elastic. I love the silver price at $20, but at $200, I would think the number of ounces demanded by investors and industry would go down dramatically. Well, first of all, what's wrong with this statement is silver is not elastic. Silver is unique in that its supply and demand are both inelastic. And I've covered this before. For something to be elastic, it means that it changes with price. So, does the demand for silver change with price? Would there be that much less of demand for silver at $200? Well, certainly not from industry, because of the tiny amounts used in industry, which actually takes up half of all the silver mined every year. The changes would actually be a minuscule price change. Even if it went tenfold, it would not have a large impact on the price of the items, because such a small percentage of their price is the price of silver. And likewise, I think that for investors, it probably wouldn't make that much of a difference either, because you have to remember the only true investors in silver are the stackers. And I think even though a lot of people don't agree with me, I think that people will still be stacking at $200. And one of the reasons I think that is because when we reach that price, we're going to be looking at the end of the fiat money system. People are actually going to be tripping over themselves to try to get something that has value that's not going to be wiped out by what's coming, which is going to be a complete reset of the system. So let's get back to this chart, and I want to talk about this chart in terms of the futures contract. Now we have to think about a futures contract and why we have them. Obviously, it gives us the ability to give forward delivery of commodities and for people also to speculate on price. So as I mentioned before, 5% or so is roughly the amount of money that is used to be put down on a futures contract. In other words, if you want to control $100,000 worth of something, whatever that is, you need to put down $5,000 cash. Now, if you think about that, there has to be some kind of reasonable regulation of that. For example, if that's set too low, if you set the amount of money that you have to put up to control a certain amount of silver to an infinitesimally small number, then obviously just one person could buy all of the silver in the entire world and control the price of it. Now, that doesn't mean they could stand for delivery, but what they could do is they could tremendously profit by it, because they could take just a limited amount of money and they could buy unlimited contracts of silver and therefore drive the price to the moon or down to zero with no money. So obviously that can't be the case. It can't be the case that it's an infinitesimally small fraction of money it takes to control a contract. On the other hand, it can't be the case that it's 100% of the money. That to control $100,000 worth of silver, you have to put up $100,000. If that were the case, then there would be no point in having futures markets. So it has to be somewhere in between those two. And the first question is, where should that be? And the second question is, on the other side of this, how much of the commodity should have to be posted? In other words, we always talk about how much the amount of dollars is required that you need to post to control, let's say, 200,000 contracts, which is 1 billion ounces of silver. And you can see here that that's $20 billion, or on contract that's going to be about $1 billion. Now, my question is, if someone's going to come onto the futures market and sell 1 billion ounces of silver, how many ounces of silver should they have to actually post? Shouldn't they actually have to deposit a certain amount of silver in a bank somewhere to prove that they actually have the silver to sell? If there were the ability to sell an unlimited amount of silver without putting any silver up, that's the equivalent of being able to buy an unlimited amount of contracts without putting any dollars up. So obviously you have to have honesty on both sides. And this brings us to this very interesting statement that we're going to look at here on the silver futures contract. Now, this is the CME's silver futures contract. As you know, we've talked about the fact that it is a 5,000 ounce contract. You can see here, this is the statement from the CME. Silver's dual role as both a precious metal for investment as well as an industrial metal for commercial use makes our silver futures and options contracts invaluable financial instruments worldwide. Affected by mine production, industrial demand, and the general health of the world economy, the price of silver can be volatile beyond what many consider acceptable risk, of course, because they want that to be the case. CME Group COMEX silver futures contracts serve as a global benchmark that provides market users with liquidity, ease of access, and unparalleled price transparency via a central point of price information. Risk management, mitigation of counterparty credit risk, and CFTC oversight. Things to know about the contract. include full 5,000 ounce sorry, I had to cough. Include a full 5,000 ounce and mini 2,500 ounce silver contracts available on the CME Globex electronic trading platform on the trading floor of the New York and for the over-the-counter clearing through the CME Clearport. Sorry. Trade a combined average daily volume of more than 57,000 contracts. Now note that one here, 57,000 contracts. So that's going to be the number that the CME gives as for what they show silver trading in volume. So if indeed it's true that this Netdania chart is the daily, then there's clearly something amiss here, because you can see during the Boston bombing smackdown, they actually registered a figure of 20 million. And if we pull into, say, the 5-minute here, we can see that they're trading a lot more than what the COMEX is. So one of these statements isn't true, apparently. Either they trade a lot more than 57,000 contracts, or the CME is not the premier contract for silver. Now we get the approved depositories for the storage of silver deliverable against the silver futures contract. And of course, that's Brinks, HSBC, Bank USA, Manfra, Della and Brooks, Scotia Makata, Delaware Depository Service Company, and JP Morgan Chase. And then this is the interesting little phrase that we get here. Price may be managed separately from physical supply. Again, price may be managed separately from physical supply. Now, one could take that to mean perhaps that there isn't a one-for-one physical supply of the commodity, and therefore they have to give that disclaimer. In other words, that price can be determined by money rather than the commodity. And that's the essence of what we're talking about here. So thinking that maybe what they're referring to, I went ahead and did a lookup of that particular phrase. And you can see here on Google that the use of that particular phrase, price may be managed separately from physical supply, occurs exactly 15 times in the history of the world. One is where someone quotes it on Zero Hedge, and here it is from the CME group, and the rest of these are about silver quoting the CME group. So the question one must ask is, why did they put this disclaimer just on the silver commodity? I suspect also that the disclaimer that the price can be volatile beyond what may be considered acceptable risk, I suspect that that is also only on silver. Very suspicious types of statements. Is this somehow their way of releasing themselves from liability when the COMEX goes bust on the silver, because someone actually comes in and stands for delivery for, let's say, 1 billion ounces of silver, and the people on the COMEX don't have it? And the reason why the people on the COMEX don't have it is because the COMEX doesn't require them to post a certain amount of physical silver if they're going to sell it on their market. Very, very interesting stuff. So back to the monthly. This is the big turnaround that we were looking for. You can see that when we finally got that turnaround on the MACD the last time back in 2008, that was the beginning of a very, very large rally, one that ultimately took us sixfold. A sixfold move from the bottom here. We're projecting would be roughly $120 per ounce. And we'll talk to you next time.